Welcome to Griffonomics.
It's great to be here.
It is Friday, February 13th, 2026. Now, looking at the calendar, you might expect us to talk about luck, superstition, maybe walking under ladders
Right.
or black cats crossing your path.
Right. Friday the 13th.
I generally don't subscribe to that stuff, but when I look at the market today, and specifically when I look at the medical technology sector, I have to admit there is something strange happening, something almost spooky.
Spooky is one word for it. Dislocated might be the more technical term.
Okay.
But yes, the vibes are off. The numbers just aren't adding up with the price action.
Right. It feels like a glitch in the matrix. We are looking at DexCom, ticker symbol DXCM. For anyone who doesn't follow this space, this is basically the heavyweight champion of continuous glucose monitoring, or CGM.
Market leader for sure.
And they just released their Q4 2025 earnings yesterday, February 12th.
Correct. And if you just read the headline numbers, I mean, you'd think the market would be throwing a parade for them.
Exactly. They smashed it, record revenues, they beat earnings expectations. The business is, fundamentally growing. And yet, if you pull up a chart of their stock performance over the last 12 months, so basically all of 2025, it looks like a horror movie.
It's not pretty.
The stock was down roughly 14% last year. Meanwhile, the broader medical device sector, the IHI, for example, was flat or even slightly up.
It is a textbook divergence. You have the fundamental business performance, revenues, margins, cash flow moving up and to the right. And then you have the market sentiment, and by extension, the stock price moving down and to the right.
So that is the mission for this deep dive. We are not just doing a tech review of glucose sensor. We are conducting a forensic investigation. We need to figure out why the market is treating DexCom like a broken growth stock when the numbers suggest they are transforming into a cash printing machine.
A powerhouse.
We're going to look at their pivot from what was a growth at all costs diabetes pure play into something much more robust, a profitable, cash-generating metabolic health powerhouse.
And to do that, we have a serious stack of documents. I've gone through the Q4 2025 earnings transcripts that dropped yesterday. I've parsed the 2025 Form 10-K filed with the SEC, and that's where the real risks are hidden in the footnotes.
Always in the footnotes.
We have the investor presentation slides from the J.P. Morgan Healthcare Conference, which gives us the visual roadmap, the big picture. And we've cross-referenced all of this with independent analysis from Seeking Alpha just to check the valuation models and make sure we're not missing something.
Okay, so before we get into the weeds of sensor chemistry and, global supply chains, let's just set the stage. You've digested all this material. What is the headline? What is the state of DexCom in February 2026?
The headline is Strategic Inflection Point. That's the term that keeps coming to mind. If you have followed DexCom for the last decade, you know them as this speculative hypergrowth story.
Right, burning cash to grow.
Exactly. Burning cash to grow revenue at 40 or 50% a year. That era is officially over. What we are seeing now is maturity. The core thesis that emerges from these documents is value in growth.
Value in growth. That sounds a bit like corporate oxymoron territory, like jumbo shrimp. Unpack that for me.
It means you are still getting significant growth. They are compounding earnings at over 20%. But you aren't paying a noonshot price for it anymore. You're not paying for a story stock. The specific number that jumped out at me from the reports is the price-to-earnings ratio.
The PE ratio, okay.
DexCom is currently trading at approximately 27 times its forward earnings.
Is that high or low? For a tech company, 27 can be totally standard.
Context is key here, historically. It's incredibly low for DexCom. Their 5-year historical average is around 54 times earnings.
Double.
Literally double. So right now, the market is offering you the stock at roughly a 50% discount to its own historical valuation, even though the fundamentals, the actual ability to generate cash, are arguably stronger than they've ever been.
So it's a half-off sale on a company that just reported record revenue and is gushing cash.
Essentially, yes. And that brings us to the core paradox we're investigating.
Yeah.
Why is it so discounted? Is the market seeing some fatal flaw that we're missing? Or is this simply a lag in sentiment? Is it just spooked?
Let's dig into that fatal flaw theory first, or rather, let's look at the operational side. Because 2025, it wasn't a perfect year for them, was it? They had some messiness early on.
They did, you're right. The 10K talks about it. They had inventory issues, some rebate challenges with pharmacy benefit managers. It was a messy year operationally. But what stands out in the Q4 report is the stabilization.
They've cleaned house.
It seems so. But the primary driver of this new value story, the real mechanism that is going to drive the profitability, is the hardware itself. We have to start by talking about the G7 15-day sensor.
The new flagship. This launched in the US on December 1st, 2025, so it's been in the wild for, what, just over 2 months now?
Correct. Very new.
Let's get technical for a minute. What actually is this thing? What makes it different?
This is their latest ICGM, that stands for Integrated Continuous Glucose Monitoring System. The integrated part is really important. It means it's designed to talk to other devices, like insulin pumps from Tandem or Insulet and smartwatches, just seamlessly.
Okay, but the headline feature is the duration.
The duration?
Yeah.
15 days. The previous standard G7 was a 10-day wear.
So you get an extra 5 days, a 50% longer life. Plus, I read in the investor slides there's a grace period.
Yes, a 12-hour grace period at the end. That's a huge usability feature. It means if your sensor expires at 3 a.m., you're not getting alarms blasted at you. It keeps working until you wake up and have a chance to change it.
Which is a massive quality of life improvement for a user. I can't imagine having to wake up in the middle of the night just to swap a sensor. But let's talk accuracy. In the world of these sensors, accuracy is everything.
Go on.
How does the G7 15 days stack up?
The metric we use here is MARD mean. Absolute relative difference. MARD. It's a statistical measure of how far the sensor's reading deviates from a reference blood test, usually a big YSI lab analyzer. In the world of MARD, lower is better, like a golf score.
Right. And what's the score for the G7?
The G7 15-day has a MARD of 8.0%. That is world-class. It is currently the most accurate CGM cleared by the FDA. For context, the early generations of these things were in the teens.
So a big jump.
A huge jump. Getting down to 8% means this device is reliable enough for a patient to make dosing decisions for insulin without a fingerstick backup. That's the holy grail.
And I noticed a feature that probably appeals to the tech crowd specifically. It connects directly to the Apple Watch.
Directly to the watch. This is a bigger deal than it sounds. Historically, the sensor had to talk to your phone via Bluetooth, and then your phone would mirror the data to your watch.
So you always had to have your phone on you.
Exactly. If you went for a run or a swim and left your phone at home, you lost your data visibility. Now, the G7 15-day bypasses the phone entirely. It talks straight to your wrist.
So for the user, it's convenience, it's freedom, more adherence. But let's put the investor hat back on. Why does a 15-day sensor matter to the balance sheet? Why does this specific hardware change drive that value thesis you mentioned?
This is where the story shifts from, medical tech to hardcore manufacturing economics. It is all about unit economics. Think about it this way. What DexCom ultimately sells is a year of sensing. There are 365 days in a year.
Okay.
With the old 10-day sensor, you needed to manufacture, package, sterilize, ship, and support roughly 36 sensors to cover one patient for 1 year.
Right. 36 individual boxes, 36 plastic applicators, 36 sets of packaging and instructions.
Exactly. With the new 15-day sensor, you only need to manufacture and ship about 24 sensors to cover that same year. That is a 33% reduction in physical volume. A third fewer units.
I see. So you're selling the same exact service, which is continuous data for a year, but you are manufacturing and shipping significantly fewer widgets to deliver it.
Bingo. Your cost of goods sold. Your COGS drops dramatically per patient year. But here is the key, and this is the beautiful part for the business model. The reimbursement, the price the insurance company pays for a month of supplies, doesn't drop by the same amount.
So you're spreading your fixed manufacturing costs over a much longer revenue-generating period for each unit.
You've got it. It's like a magazine publisher figuring out how to print the same content on paper that costs 30% less, but they get to charge the same subscription fee. The profit margin instantly expands.
And are we actually seeing this in the numbers yet, or is it just theoretical?
Oh, we are absolutely seeing it. In the Q4 2025 earnings report, their gross margin hit 63.5%. That was up 200 basis points. It's 2 full percentage points just for the previous quarter.
In a single quarter.
In a single quarter. And their forecast for 2026 is predicting gross margins of 63 to 64%.
Yeah.
That expansion is almost entirely driven by this shift to the 15-day form factor.
That is a massive jump. In manufacturing, squeezing out 200 basis points usually takes years of Six Sigma projects and, optimization. They did it with one product cycle.
Exactly. And they are getting more efficient in the supply chain, too. You mentioned the cleanup of 2025 earlier.
Yeah.
Part of their margin compression last year was because they were having to use air freight.
Because they were behind on inventory. They were scrambling.
Yes. When you are scrambling to meet demand or when you have supply chain hiccups, you have to put your boxes on planes. That is incredibly expensive. In the Q4 call, Management confirmed they have stabilized that. They're back to using low-cost ocean freight. They've rebuilt their inventory safety stock.
So they aren't paying those insane expedited shipping fees anymore. They can put it all on a boat, which costs a fraction of the price.
Right. And looking further down the road, they have a massive new manufacturing facility coming online in Athenry, Ireland. That is expected to start production in Q4 of this year, 2026.
So why Ireland? Is that just a tax play?
Tax is part of it, sure. The corporate tax rates there are famously favorable, but it's also about global scale and localization. If you are selling to Europe, the Middle East, and Africa, you want to manufacture in Europe.
Cuts down on shipping time, tariffs.
Tariffs, currency exposure, all of it. It's the long-term play for global margin defense and expansion. It makes their whole operation more resilient.
Okay, so that covers the core business, the intensive insulin-using population, that's the engine. But the sources all mention a new frontier. This is where the language shifts from diabetes management to metabolic health. We need to talk about Stelo.
Stelo. This is a huge deal. This is DexCom's first over-the-counter sensor. No prescription needed.
Which is a regulatory breakthrough in itself. If I want one, I don't need to go beg my doctor for a script. I can just buy one.
You can go to their website, or more importantly, you can now go to Amazon. It launched partially in 2025, and that's a huge shift in their go-to-market strategy.
So who is the target here? If you aren't on insulin, why do you need a sensor that, has a little needle in your arm?
The target audience is massive. We are talking about the estimated 98 million Americans with prediabetes, plus the millions with type 2 diabetes who are not using insulin.
So this isn't for managing a life-threatening condition. This is for optimization.
It's for optimization and prevention. These are people who aren't in immediate danger of a hypoglycemic coma, but they want to understand how their body reacts to food, exercise, stress, sleep.
So the biohackers, the Tim Ferriss crowd, or just people trying to lose 20 pounds?
It definitely started with the biohackers, but Stelo is aiming squarely for the mainstream wellness market. And the 2025 scorecard is pretty impressive. In just a partial year, Stelo generated about $130 million in revenue.
Wow, okay.
And over 500,000 users have already tried it.
500,000 people. That is not a beta test anymore. That is a real consumer product with traction.
It is. But the hardware is only half the story here. The real differentiator for Stelo, and this is something the analysts and the reports are buzzing about, is the software, specifically the AI integration that's coming in 2026.
I read about this in the JP Morgan slides. It's solving the food logging problem, which is the bane of every health app's existence.
Right. Have you ever tried to log your food consistently? Using an app like MyFitnessPal or Noom?
I think my record is about 3 days on every single app I've ever tried. It's so tedious. Typing in medium-sized apple or trying to guess how many grams of rice are in a bowl, it's the worst user experience on earth.
Everyone hates it. It is the #1 reason people churn from health and wellness apps. DexCom knows this. So the new Stelo app uses AI-based computer vision.
So you just take a picture of your food.
You just take a photo of your meal. The AI analyzes the image. It estimates the macronutrients, carbs, protein, fats, and it logs it for you automatically.
So I could snap a picture of my turkey sandwich, and the AI will say, okay, that looks like whole wheat bread, turkey, cheese, maybe 40 grams of carbs.
That's the promise. But then it does the magic part. It correlates that specific meal with your glucose data from the sensor. So 2 hours later, the app can send you a notification that says, hey, that sandwich caused a massive spike, likely because of the bread.
Or, hey, you ate that pasta, but you went for a walk immediately after, and look, your glucose stayed perfectly flat.
It is a Pavlovian response. It's an immediate, actionable feedback loop. It actually trains you to make better choices.
That's powerful, and the engagement numbers are already there.
They're wild. DexCom reported that over 10 million meals have already been logged in the ecosystem. This isn't just a medical device anymore. It's a lifestyle tool. It's a data company.
It sounds like they are taking their design cues from consumer tech, not from traditional medical devices.
They explicitly said that in the JP Morgan presentation. The new app interface, which is launching this year, is taking cues from apps like the OURA Ring or Whoop.
Dark mode, sleek graphs.
Exactly. Not a sterile, clunky medical chart. And moving to the Amazon storefront was a key part of that strategy. It normalizes the purchase. You go on Amazon, you buy your vitamins, you buy your protein powder, and you add a Stelo sensor to your cart. It's just another wellness product.
So let's talk about the strategic value here. Is Stelo just about making that $130 million, which is nice but still small compared to the core business? Or is there a bigger play?
It's a funnel. A massive, profitable funnel. Think about the progression of the disease. Diabetes, for many people, is progressive. If you catch someone at the pre-diabetes stage with Stelo, they're now inside the DexCom ecosystem.
Right. They have the app on their phone, they trust the brand, they're used to the data.
Exactly. So if their condition unfortunately worsens 5 years down the line and they do need a prescription CGM, who are they going to choose? They aren't going to go research Abbott or Medtronic. They are already loyal DexCom customers.
It's a brilliant customer acquisition strategy, and they're not losing money to acquire them, they're making money.
Precisely. It's customer acquisition cost being paid for by the customer. Usually companies spend a fortune on marketing to acquire customers. DexCom is making a profit while doing it. It's an incredible model.
And I should mention, the sources also talk about their other software, like the Smart Basal software and DexCom Clarity. It seems like they're building this whole software ecosystem that makes it very, very hard to leave once you're in.
It's incredibly sticky. Smart Basal is huge for the insulin users. It helps automate titration, which is a complex process of adjusting your background insulin dose. Once a patient and their doctor trust that software to manage their insulin, they aren't going to switch to a competitor just to save a few bucks.
Okay, so we have the G7 15-day driving margins. We have Stelo opening up this huge consumer market. But there's a specific term in the investor slides that caught my eye. They call it the green circle. It sounds like some kind of secret society.
The green circle is DexCom's favorite chart right now. You can tell they're excited about it. It represents the immediate low-hanging fruit for the core business.
What does it represent specifically?
It represents 9 million people in the U.S.
Okay.
These are 9 million people who already have insurance coverage for a prescription CGM. Their plan will pay for it right now, but they are not yet using one.
Wait. Let me get this straight. There are 9 million people in America who could get this device for a low copay, or maybe even for free, and they just aren't.
Correct. The coverage is there, the patients are there, but the connection hasn't been made.
Why? I mean, that seems like leaving free healthcare on the table. What's the barrier?
It's primarily the type 2 non-insulin users. The barriers have always been friction and awareness. Historically, getting a CGM prescription was a total nightmare.
How so?
The primary care doctor had to fill out all these specialized forms, fax them to a durable medical equipment, a DME supplier. Then the DME supplier has to call the patient, verify insurance.
Oh.
It was a bureaucratic maze that could take weeks.
And primary care doctors are already completely overworked. They don't want to spend 20 minutes on the phone and faxing forms for a patient who isn't on insulin and in immediate danger.
Exactly. It just wasn't worth the hassle for them. But this is where the execution play comes in. This is DexCom's big focus for 2026. They've been rolling out something called DexCom Direct.
What's that?
It's a direct integration with the big electronic health record systems, or EHRs, like Epic and Cerner.
Explain that for the non-doctors listening. What does that actually mean?
So when your doctor is sitting at their computer typing in your notes during your visit, they are using the EHR. DexCom Direct integrates right into that workflow. Now, if a doctor sees a patient who qualifies, say, a type 2 diabetic on oral meds, a little alert can pop up right on their screen.
Like a recommendation.
A recommendation. The doctor can then click one single button to prescribe the DexCom. The system automatically handles the eligibility check and sends the prescription to the right pharmacy or supplier instantly.
So they turned a 20-minute, multi-step faxing nightmare into a one-click checkout.
Exactly. It removes all the friction. They have over 160 major health systems live or onboarding with this right now. This is why they are so confident they can start capturing that green circle of 9 million people.
And the beauty of that is it doesn't require a new law. It doesn't require new FDA approval. It just requires the sales team to get those health systems plugged in.
It is pure sales and marketing execution.
That is pure execution. But there is another layer here, a potential bonus round that is much higher up the tree. We need to talk about the Medicare call option.
Ooh, I love a good call option.
Yeah.
This is the potential upside that isn't priced into the stock yet.
Correct. Right now, DexCom is anticipating a coverage decision from CMS, that's the Centers for Medicare and Medicaid Services, for the broader type 2 non-insulin population. We're talking about approximately 12 million people on Medicare.
What's the current status for that group? Currently, Medicare covers it for insulin users and some other specific cases, like those with a history of dangerous hypoglycemia. But if they expand it to all type 2s, regardless of insulin use, That opens the floodgates to a massive new patient population.
And here's where it gets really interesting for the stock, because looking at their guidance for 2026.
The guidance, that 5-point-something to $5.25 billion revenue target, does not include this potential Medicare expansion. They've been very clear about that.
So if CMS comes out in July or October and says, yes, we're covering it,
DexCom likely beats their revenue guidance significantly. The stock would almost certainly react very positively.
and if CMS says no or not yet,
They still hit their guidance because the expansion wasn't baked in to begin with. The base case doesn't change.
that is what you call an asymmetric risk profile. Heads, I win big. Tails, I stay the same.
Precisely. The guidance they gave is the floor. The Medicare decision is the potential ceiling, and the evidence is on their side. DexCom has this big study called the Type 2 NIT Registry. NIT stands for non-insulin therapy.
What did that show?
They have 12 months of real-world data showing that when these patients use a DexCom, their A1C, their average blood sugar, drops significantly, and they tend to lose weight.
So they can go to the government and prove that paying for the device today actually saves money on treating expensive complications like heart disease or kidney failure 10 years from now.
That is the exact argument. And in the world of healthcare economics, that kind of outcome data is king.
Let's shift gears to the financials then, because you might said earlier that this company is maturing. And usually when a tech company matures, it means they stop growing at a breakneck pace and they start hoarding cash. Is that what's happening here?
Well, they're certainly generating cash. 2025 was a huge milestone year for them. For the first time ever, DexCom surpassed $1 billion in annual free cash flow.
That is the billion-dollar moment. That really puts you in a different club of companies.
It does. It signals stability and profitability.
Yeah.
It means the business is self-funding. They don't need to go to the capital markets to survive or grow anymore. And their balance sheet reflects that. It's a fortress. They are sitting on about $2 billion in cash and cash equivalents.
So what are they doing with all that cash? Are they just letting it sit there, buying private jets?
No, they are doing what responsible, mature allocators of capital do. First, they cleaned up their debt. They settled $1.2 billion in convertible notes using cash.
Convertible notes, just to clarify for everyone, that's debt that could have turned into new stock and diluted the existing shareholders, right?
Exactly. So by paying it off in cash, they prevented that dilution. It's a very shareholder-friendly move. And secondly, and maybe more importantly, they authorized a $750 million share buyback program.
A buyback, that's always a strong signal for management.
It's the strongest signal management consent. It says, we think our stock price is too low, so we're going to use the company's cash to buy it ourselves. When a company buys its own dip, you should pay attention.
It aligns perfectly with that 27x PE ratio we talked about at the start. They're looking at the same multiple we are, and they're saying, this is cheap.
Exactly. And, looking at the 2026 guidance, that 11 to 13% revenue growth, some growth investors might sniff at that. They might say it's slow compared to the 40% growth of 5 years ago.
It's not a hyper-growth story anymore.
It's not. But 13% growth on a $5 billion revenue base with expanding gross margins and huge free cash flow, that is a compounding machine. It's not a lottery ticket anymore. It's an investment-grade asset.
Okay, but we have to address the elephant in the room, the big looming fear. The reason some investors are terrified of this entire sector, the reason the stock might be down 14% despite all this good news.
You mean the drugs?
The drugs, the GLP-1 agonists, Ozempic, Mounjaro, Wegovy. The narrative out there is simple and terrifying. If everyone takes a magic shot that makes them lose weight and cures their diabetes, then nobody needs a glucose monitor. Is DexCom dead?
That is the fear narrative. It's pervasive, and it definitely weighed on the stock in 2025. But if you look at the actual data, and if you listen to what CEO Jake Leach said in his CNBC interview after the earnings call, the reality is almost the complete opposite.
So rebut the fear. Why aren't GLP-1s the DexCom killer?
Because they're complementary tools, not competitive ones.
Mm-hmm.
DexCom sees GLP-1s as a tailwind. Think about the patient experience for a second. These drugs are expensive.
Like $1,000 a month, expensive without good insurance.
Right. And they can have side effects, nausea, fatigue. When people are spending that kind of money, or when insurers are paying for it, they want validation. They want a dashboard to see if it's actually working.
Ah,
The CGM provides that immediate feedback loop. It's the proof.
I see. So you take the expensive shot, and then you look at your graph on your phone to see the glucose curve flattening out. It validates the investment and keeps you motivated.
Exactly. And then there's the behavior modification aspect. The drug suppresses your appetite. It tells you when to stop eating. But the CGM tells you what to eat when you do eat. It shows you how a slice of pizza affects you versus a salad with grilled chicken.
And what's the actual data say?
DexCom's data actually shows that users who are on GLP-1s tend to use their CGMs more often and are more engaged than those who aren't. They become power users of their health.
That's totally counterintuitive, but it makes perfect sense. If you are committed enough to inject yourself weekly with an expensive drug, you are probably committed enough to wear a sensor to maximize the benefit.
Precisely. There's also the issue of muscle mass. One of the big downsides of rapid weight loss from GLP-1s is that you can lose a lot of muscle along with the fat, sarcopenia. To prevent that, you need to hit your protein targets every day.
Ah, and you're connecting the dots back to the new Stelo app.
It's exactly. The new Stelo app with the AI-based protein logging. That pairs perfectly with a GLP-1 user who needs to ensure they are getting enough nutrition to maintain muscle. So instead of DexCom versus Ozempic, the real thesis is DexCom plus Ozempic.
Okay, so the GLP-1 risk might be overblown or at least misunderstood by the market, but we are doing a deep dive here, not a puff piece. We need to look at the real risks. No investment is risk-free. What keeps the CFO of DexCom up at night?
There are definitely headwinds, and to their credit, they list them in the 10K. The big one is pricing pressure.
Is that just competition from Abbott and Medtronic?
It's competition, yes, but it's also the channel mix. As they sell more and more through retail pharmacies rather than the old durable medical equipment suppliers, the whole reimbursement structure changes. They have to pay hefty rebates to PBMs, the pharmacy benefit managers.
The infamous middlemen of healthcare.
The middlemen. And those rebates eat directly into the average selling price, or ASP. So DexCom might sell more units, but they keep a little less of each dollar.
Which is why the G7 15-day cost savings are so critical.
They're absolutely essential. They need to lower their manufacturing cost to offset that lower net selling price. It's a constant race between their operational efficiency and the pricing pressure from the payers.
And what about regulatory risks? I saw something in our stack about an FDA warning letter back in March of 2025. That sounds pretty scary.
It sounds scary, and it's something to take seriously, but we need to put it in context. The FDA issued a warning letter citing non-conformities at their manufacturing facilities in San Diego and Mesa.
Non-conformities. That's very vague. Does it mean the sensors don't work or are unsafe?
No, it was more about their internal processes, things like documentation, complaint handling procedures, and manufacturing process controls. Importantly, the letter did not restrict production or shipping. They didn't have to pull any products off the shelf.
It's a headache.
It's a major headache. It adds a layer of compliance risk and cost. They have to spend a lot of time and money to fix those processes to satisfy the FDA. It's a distraction.
And legal risks. I saw mentions of lawsuits as well.
Yeah, there is some class action litigation. Usually when a stock drops, you see lawsuits from investors who feel they were misled about something, in this case, the G7 launch timeline, or the severity of those regulatory issues.
Is it serious or just standard ambulance chasing when a stock has a bad year?
It's often the latter, but it's still a distraction for management and a potential financial liability you have to account for. As part of that hangover from the messy parts of 2025 that we mentioned, it contributes to that negative sentiment we talked about at the beginning.
Got it. So pricing pressure, FDA compliance, and lawsuits, those are the clouds.
And there's one more big one on the horizon: competitive bidding.
That sounds ominous.
It is a mechanism that Medicare uses to drive down prices for medical equipment. Basically, they make all the suppliers bid against each other for contracts. Who can sell us this widget for the absolute cheapest price?
And that's not happening for CGMs yet.
Not yet, but there is a looming risk that in 2027 or 2028, Medicare will apply competitive bidding to the entire CGM category.
And that would crush prices across the board for the entire industry.
It would likely compress them further, yes.
Yeah.
DexCom knows this is coming, which is another reason why they are diversifying so aggressively into Stelo, which is cash pay, no Medicare involvement, and into international markets.
Speaking of international, that's a relatively small piece of the pie for them right now, isn't it?
It's only about 28% of their total revenue. But the population of people with diabetes outside the U.S. is vastly larger. The problem has always been price. In places like France or Japan, the national healthcare systems aren't going to pay the premium U.S. prices for this tech.
So what's the strategy there? You can't just sell at a loss to gain market share.
You have to segment the market. They are launching what they call tiered products. You'll hear names like DexCom 1 and DexCom 1 plus Stelo. These are versions of the sensor that might have slightly different software features or stricter limitations, but are designed to be sold at a much lower price point.
So they can compete head-to-head with Abbott, who has historically been very strong internationally with their lower-cost Libre system.
Exactly. They are fighting a price war in Europe while playing a premium technology game in the US. And again, that new factory in Ireland is absolutely key to winning that price war. You have to manufacture in Europe, for Europe, to make the numbers work.
Okay, wow, we've covered a ton of ground. We've looked at the G7 tech, the Stelo consumer pivot, that green circle opportunity, the rock-solid financials, and the very real risks. Let's try to land this plane.
Let's do it.
If you had to summarize the entire thesis for a listener who is looking at DexCom stock today on Friday the 13th, 2026, what is the final verdict from our deep dive into these sources?
The verdict is that the market seems to be mispressing the maturity of this company. We have a business that is still growing at double digits, printing over $1 billion in cash a year, and it's sitting on a $2 billion war chest.
And operationally?
Operationally, they are launching a higher margin product with a G7 15 day, and at the same time, they are tapping into a massive new consumer market with Stelo that their competitors haven't touched yet.
And the valuation just doesn't reflect that strength.
It doesn't seem to. It's trading at 27 times forward earnings. That is a value multiple for a company with this level of growth and quality. The sources, when you put them all together, support a speculative buy or a strategic buy rating. You are buying a high-quality asset during what appears to be a temporary dislocation of sentiment.
It feels like the market is bored with them because they aren't the shiny new hypergrowth penny anymore, but the actual business is fundamentally better than when they were that shiny penny.
That is exactly it. Sometimes boring makes you a lot of money, the speculative froth is gone, and what's left is a cash compounding machine.
I want to leave our listeners with one final thought, something to chew on over the weekend. We talked about Stelo and the AI food logging. If DexCom succeeds with that, if they get millions of non-diabetic people taking pictures of their food and correlating it with their blood data, they are building the world's largest, most detailed database of how human bodies react to nutrition in real time.
That's a data set no one else has, not even the big tech companies. Not at that scale, with that level of clinical accuracy.
Right. So my question is this. At that point, does DexCom stop being just a diabetes company and start being a metabolic data company? And if they own that data, that metabolic graph for millions of people, who does that make them a competitor to?
Is it still Abbott? Or is it suddenly Apple and Google?
That is the trillion-dollar question. If they own the metabolic graph, they could become the operating system for human health.
Something to think about.
That's it for this deep dive into DexCom. Thanks for listening.
Risk defined. Portfolio protected.
See you next time.